Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 19, titled Using the Ellman Calculator to Monitor Hitting a Double Results, using covered call writing exit strategies to generate two income streams with the same trade. Now, position management is the third of the three required skills we need to become elite option sellers. The first two, stock selection and option selection. Once we enter a covered call trade, we immediately move into position management mode. And that means how to handle situations where stock prices decline in value. So that's one of the things that we worry about. Now, if that happens frequently, we can buy back that short call that we originally sold, and then if the share price recovers, resell that very same option in the same month, thereby generating two income streams. So that's what the hitting a double exit strategy is all about. So just assume now that we sold a call. That's our covered call position. We buy the stock first and sell the call, and then buy back that call. We use the 20%, 10% guidelines. So what that means is, in the first half of the contract, we'll buy back that option if it reaches 20% of the original sale price or lower, and then we change that to 10% halfway through the contract. So as an example, if we sold an option for $2, we put in a 20% limit order to buy to close at 40 cents or less. Midway through the contract, if that has not been executed, we change that 40 cents to 10% or 20 cents. All right, so then if it's early in the contract, we wait to see if share price recovers, because if it does, then it gives us an opportunity to sell that same option again at a higher price, thereby generating two income streams. Now, what if there's no price recovery? Well, then we have plan B, which could be rolling down to a lower strike price, or plan C, just selling the stock if it's grossly underperforming the overall market. So we always have to have a plan in mind, and then a backup plan in mind, and sometimes a third backup plan in mind. All that has to be prepared ahead of time before we enter the trade. Now, if we were to visualize graphically what a hitting a double trade would look like, normally the trade would be entered when the share price was in an uptrend, because those are the kind of stocks that we like. At worst, it would be flat, moving sideways. But generally, we like an uptrending stock. Now, then the trade is entered, the stock is purchased, the call is sold, but what happens? The price goes down. Now, if our 20% guideline is met, we buy back that option. So you can kind of visualize an uptrending stock, then it goes down in price. Now, if it's early enough in the contract, we may want to wait a couple days, maybe even up to a week, and see if it recovers. If it does recover, we could sell that same option again at a net profit as far as the exit strategy is concerned. So for example, if we bought a stock at 30, sold the 30 call for 95 cents, then we put in a buy to close limit order at 15 to 20 cents. We buy it back when it goes down. Then it recovers. If it moves up to 70, we would have a net exit strategy credit of 70 minus 15, $55 per contract. So you would get this classic V-shaped pattern where the price of the stock declines and then goes back up over time. So let's set up a hypothetical hitting a double series of trades, and then we'll put it into the multiple tab of the Ellman Calculator to show you how the calculator can monitor your hitting a double positions over the lifetime of that series of trades. So let's say we bought a stock at $48, sold the out of the money 50 call for $2. There is our covered call trade. Now, let's assume now the price of the stock declines such that the 20% guideline is met. We buy back the option that we sold for $2, we buy it back at 40 cents. Okay, now let's assume we wait a couple days. Boom, the price of the stock goes back up. And we're able to sell that same option, well, not for $2 this time because time value is eroding. Let's say we get $1. So we bought it back at 40 cents and we resold it at $1. We made a $60 per contract profit by hitting a double. So let's give an overview of these trades. It's 3 legs of the trade. Let's look at an overview. First, what is our cost basis? Well, it's $48. Right? That's what we paid for the stock. That stays the same throughout the series of trades. What is our option, credit, or debit? Well, that is what moves around. We sell an option, we get a credit. We buy it back, we get a debit. So it can move in both directions. Now, the upside potential, where we bought the stock at 48 and sold at 50 call, that remains a constant at $2 is the max. So that stays the same also. So the only thing changing is the option, credit, or debit. All right, let's feed this information now into the multiple tab of the Ellman Calculator. And on the left side of the spreadsheet, you'll see blue cells. That's where we enter the information. So let's assume we put on the top row the initial trade where the stock was purchased at 48, the 50 call was sold at $2. All right, now on the right side of the spreadsheet, you'll notice that the return on the option, or ROE, is 4.2%. That's 2 divided by 48. What about upside potential? Yes, another $2 from 48 to 50. So that's another 4.2%. In this particular trade, based on the initial setup, we have an opportunity for up to an 8.4% 1-month return. Now let's assume for a moment that the price declined and we bought back the shares, the option rather, at 40 cents. That met our 20% guideline. Well, now we had an option credit initially of $2, but now we have an option debit of 40 cents. Net, we have an option credit of $1.60, right? So that 4.2% return on our option, or ROE, moves down to 3.3%. The upside potential remains the same. Now, another thing that changes is the break even. So in the initial start of the trade, we bought a stock at 48, sold a 50 call for $2, making our break even $46. Now, when we added on, we bought back the option for 40 cents. Now our break even moves up by that amount, so our break even is $46.40. Now let's assume for a moment the price of the stock does in fact move up, bringing the option value up to $1. So what we do is we sell to open that same 50 strike at $1. That means that the break even now moves from $46.40 down to $45.40, moves down by the dollar. So the return on our option, though, moves up, right? Because we have a net option credit now of $2.60. So remember, we started at 2. We bought back the option at 40 cents, making our net option credit $1.60. And now we sold the option for $1, bringing our net option credit up from $1.60 to $2.60. That now represents a 5.4% 1-month return. Same upside potential of 4.2%. So if we just look at the return on our option movement during the course of these trades, it went from 4.2 to 3.3 to 5.4. So when the smoke clears at the end, we moved up 1.2% from 4.2 to 5.4. It took us about 4 minutes to do both legs of these hitting a double trades. Well worth the time and effort. So let's kind of review now. The hitting a double exit strategy has 3 components to it, right? We enter the trade, we buy back the short call, and we resell the short call. We could use the multiple tab of the Ellman Calculator to monitor these trades. All we have to do is adjust the option credit up or down, depending on if we're selling an option or buying it back. Now, the actual final results of the trade, realized or unrealized, will not be calculated until we know the stock price at expiration. So we can't really factor that in because that's also something in motion. Now, for those of you who don't already have the basic Ellman Calculator, you can get a free copy by going to our website, www.thebluecollarinvestor.com, and click on the free resources link at the top black bar of all of our web pages. We also have several educational products related to covered call writing in the BCI store. We have the #1 book on covered call writing, titled The Complete Encyclopedia for Covered Call Writing. The classic edition, or volume 1, should be read first, and then we also have a volume 2. We also have some upper level books on options in the store, and we have an online streaming DVD program with a downloadable workbook that's recently been updated. So for those of you who like to take advantage of videos, and you're kind of watching one now, then you might want to give consideration for this online streaming DVD program. So ladies and gentlemen, there you have it, BCI podcast number 19, using the Ellman Calculator to monitor hitting a double results, using covered call writing exit strategies to generate 2 income streams in the same trade. Pretty neat, huh? Well, ladies and gentlemen, I want to thank you all for taking the time to listen to this podcast. I hope you enjoyed it. And most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.